Gold is telling you that there's a lot of inflation in the pipeline.
This is something I've been warning about for years. It wasn't a question of if, only when. For the longest time, I expected an external shock to trigger a collapse in confidence around the dollar. What I didn't expect was that we would be the ones to puncture our own bubble. We pricked it, and now there's a lot of air coming out. A lot of people look at our huge trade deficits and reach the obvious conclusion. Foreigners are cheating us, stealing our jobs, ripping off our markets. That's a politically convenient story, but it's a mistake. Trade deficits are a symptom, not the disease. The real problem is homegrown. For decades we have lived beyond our means. We consume more than we produce. We finance that gap by borrowing, selling assets, offshoring production, and attracting foreign capital to paper over the shortfall. How does that work in practice? We buy more than we make because we borrow to do so. We sell off factories and supply chains to other countries. We take on debt, and the rest of the world holds that debt and holds our assets. They enable our higher standard of living by providing goods, buying our stocks and bonds, and lending us money at low rates. That foreign capital keeps interest rates low, consumer prices down, and stock valuations high, so we feel wealthy on paper even while our production base erodes. Now imagine that arrangement reversed. If the flow of foreign capital stops, and if foreign buyers reduce their appetite for our dollars and our assets, the consequences are straightforward and brutal. Interest rates will spike because we can't borrow cheaply anymore. Consumer prices will rise because the flood of cheap imported goods will recede. Stock prices will fall because foreigners won't be propping them up. In short, Americans will see a dramatic decline in living standards and a large drop in net worth. That correction is painful, but it's also necessary if we are to stop living on borrowed time. We're already seeing early signs. Precious metals are moving, not because of some speculative frenzy, but because foreign central banks and sovereign funds are reallocating reserves away from dollars. When a broad group of national treasuries and central banks quietly accumulate physical metal, you don't just call it an asset allocation tweak, you call it a strategic pivot away from the dollar's dominance. If countries want to reduce their dollar exposure, what do they replace it with? Historically, the natural alternative is something tangible with long-term value, an objective, reliable store of wealth. This shift is not just about one asset rising in price. It's about global monetary architecture changing. If foreign demand for dollars falls, we pay higher rates, import fewer goods, and lose the external financing that subsidized our consumption. That means painful internal adjustments. We must save more, produce more, and rebuild supply chains. In short, we must become more productive, not through shopping, but through manufacturing, innovation, and infrastructure. Consumption without production is unsustainable. The difficult truth is that production creates real demand. Consumption does not create production. At the same time, asset markets will recalibrate. Physical stores of value become more attractive to risk-averse states and institutions. For private investors, an obvious place to look is at companies that produce those scarce resources. The producers, not just the commodities themselves. Mining and extraction businesses, for example, become vital when physical supply is the bottleneck. The firms that extract and deliver these tangible assets will see their profit margins surge when the commodity prices are revalued by global reserve reallocations. In those situations, mining equities are often trading at multiples that make little sense given the commodity backdrop, cheap compared to the value of what's still in the ground. At the same time, modern market narratives, crypto hype, flashy ETFs, celebrity endorsement, have diverted private capital away from traditional hedges. That means a vacuum. Institutional buyers have been quietly hoovering up actual physical reserves while private investors were distracted. When the private sector finally wakes up, a second, much larger wave of buying could follow. That's when the miners, the producers, and the firms with real physical assets become the big winners. Now let's talk policy mistakes, because they matter. For a long time, monetary authorities talked about transitory inflation and treated price pressures as a temporary aberration. That view underestimated structural imbalances, decades of credit expansion, fiscal deficits, and the hollowing out of industrial capacity. Worse, some of the stress tests and contingency planning never assumed the combination of stagnation with rising inflation, stagflation. Many policymakers were unprepared for a world where higher inflation coexists with weaker growth and rising rates. They focused on headline stability and missed the structural rot. When monetary policy eventually tightens in earnest, the timing is crucial. If rates go up too quickly when the financial system is fragile, You risk bankruptcies and systemic failures. If policy is too loose while balance sheets are stretched, you get runaway inflation. The truth is, the system has very little room to maneuver. Leverage is high in many corners of the economy. Interest-sensitive sectors would feel enormous strain if rates returned to truly restrictive levels. That's why some central banks opt for stopgap measures instead of durable cures. But stopgap measures only postpone pain, they don't solve imbalances. So what happens to the domestic economy? Expect an initial wave of hardship. Layoffs, bankruptcies, and sputtering consumer demand will hit sectors that rely on cheap imports and cheap credit. Small businesses that enjoyed low borrowing costs will feel the pinch first. The service-heavy parts of the economy, the areas that thrived on discretionary spending funded by cheap credit, are particularly exposed. But this is not simply a catastrophe, it's a cleansing. If we retool our economy to produce instead of consume, if we re-expand supply chains and invest in domestic capacity, the long-term payoff is real. The transformation will be painful, and whether it leads to sustainable recovery depends on policy choices and private responses. One of the most important points to understand is that this isn't necessarily a global disaster. It could be a domestic crisis for the currency-issuing country while the rest of the world benefits, because the previous global equilibrium required surplus countries to run deficits on our behalf. If they stop doing that, they free up capital to invest at home. Emerging markets, in particular, could reap the rewards: more investment, more consumption, and stronger domestic markets. The liquidation of dollar-denominated debt in a depreciating currency can act like a debt jubilee for foreigners who borrowed in dollars. As the dollar weakens, real burdens shift. That's a transfer of wealth that rebalances the global economy away from the old arrangement. We must also acknowledge political incentives. Politicians can propose tariffs, trade wars, or short-term fixes to make headlines and appear to fight back against global trade. But those measures often accelerate the very adjustment they claim to prevent. Tariffs can shrink demand for imports, which sounds good politically, but that also shrinks the ability of other countries to buy our exports and to hold our debt. The end result can be exactly the break in the financing loop that precipitates a currency revaluation. Policy must be done carefully. Otherwise, it simply speeds up the unwinding of a malinvestment-heavy era. So what should investors and ordinary people think about? First, realize that buying something tangible during a monetary reckoning is not panic, it's prudence. Physical assets and productive capacity are anchors when confidence in paper currency erodes. But timing matters. In many cycles, the best returns come from buying producers, the businesses that will profit from higher real prices for scarce goods, rather than the raw commodity itself. That's because producers offer leverage. When the commodity price rises, producers' profits can expand much faster than the commodity's price. Second, don't expect policy to be simple or consistent. Central banks and fiscal authorities will be trying to balance financial stability with inflation control. They may oscillate between tightening and reinflating. That kind of policy whiplash makes volatility the norm and long-term planning hard. Diversification and real assets become attractive in such a world. Third, remember the larger narrative. This isn't about a single election cycle or a single leader. It's a structural, multi-decade shift in how the world allocates capital and production. We grew used to a world where one currency played a dominant, privileged role. When that role erodes, the adjustment is profound. It will involve short-term pain and long-term reallocation of capital back into actual productive activity. Lastly, consider the moral of this whole episode. You can't sustainably live above your means as a country any more than you can as an individual. If consumption vastly outpaces production, the difference must be funded somehow, and that funding has geopolitical and economic costs. The necessary correction will be difficult, but it offers a chance to rebuild a healthier, more resilient economy if we accept the reality and focus on production, saving, and long-term investment. So what do I expect? Higher inflation for longer, a weaker currency relative to tangible assets, a painful domestic contraction as we adjust, and an eventual reorientation toward production. The rest of the world, freed from the obligation to finance our consumption, will reap benefits. Precious resources and the companies that extract and process them will shine. Policy mistakes can amplify pain, but the underlying shift is already underway. If you want to prepare, think long-term. Focus on real assets, producers with real output, and rebuilding capacities rather than speculative paper gains. And don't be lulled by temporary market breathers. The big story is structural, and it will reward those who understand the economics beneath the headlines. We pricked our bubble. Now we must decide whether to turn the correction into reconstruction or to let it turn into lasting decline. The choice will shape the decade ahead.